Yeah.
See, and this is what I love about the fact that we get to talk about this today with everything that's going on, because you and I have about 70% overlap in what we think.
Uh-huh. And
And the question is,
we're not entirely of one mind, right? We're not the board.
no, we are not. So we have a little bit different view on, I think, what the impact is going to be, and so it's going to be good to talk about. And I think it's a good setup.
And you probably didn't know this, but we're in a threesome right now. I got my 13-year-old shadowing me today.
Nice. It's shadow your parents at work.
Yeah, that's right. He's got his notes right here. He's gonna know what the market's doing today. And we're talking tariffs.
Yeah.
What a better day to be here. Tariffs. What does it really mean? Market indications, option market indications. We'll look at the console, see if any big trades are coming through. There was a big trade earlier today in LQD. The bond market could be the one that really gets hit here. We'll kind of hit that. But Blake, what's your first thoughts on the tariff ruling?
Well, so before we get into the tariff ruling, I want to say what was going on before and what did the tariffs do? Because taking them off, there's a whole slew of unexpected or unplanned on consequences and costs. So do you believe tariffs are inflationary or deflationary by nature?
Well, at the end of the day, if your argument is that tariffs are inflationary, then every policy you pass on companies is therefore inflationary, right? Because if you say we directly pass through any sort of regulation on a company, if that is immediately passed on to consumers, then every tax, every regulation is therefore a tax on consumers. So the question is, if you say that tariffs are therefore inflationary, then you do believe every potential regulation, every potential tax is therefore immediately passed on consumers, which it's not, right?
Right, so I wouldn't say immediate. You keep putting the immediate in there, and I don't agree with that. I think anytime you add cost to anything, sooner or later either mean lower earnings for the producers and higher cost for consumers.
Right, but those arguing saying that tariffs are inflation are saying that it's going to create inflation. Even the Fed saying we're looking for it months after it's passed, so after it's enacted. So there is a degree of rhetoric out there that says it is immediate. But again, I don't get it from a political perspective, is that, there's a lot on one side of the aisle that's loved tariffs in the past, suddenly don't like them, and are saying they're creating immediately rising costs for consumers, and yet they want higher taxation for companies, right? And so there's a lot of political going on right now. But yeah, I mean, tariffs can create inflation temporarily, right? One time as that adjustment takes place, to the degree companies can pass it on to consumers.
So so the degree they can pass it on. But,
and it does depend on the level, right?
But I'd say right. And I'd say absolutely, no matter whether you want to argue inflation or not, you have to at least approach it from the idea that it's a tax. It's a tax being implicated somewhere, and someone's paying for it. And in the end, taxes do create inflationary pressure. And I say inflationary pressure without growth, because who gets that tax?
Yeah. But here's the thing with the tax. I really don't have a problem calling it a tax, to be honest, because but how do you get a company like Apple to pay taxes? How do you get a company like Nvidia to pay taxes? Because they really pay very little taxes in the United States at all, right? Because they're not a US company, right? Apple, they'll go to the Caribbean, they'll go to Ireland, right? They'll do all these mechanisms to avoid US corporate taxes. So how do you really tax a large company like Apple without a tariff? So if we call it a tax, which I'm okay with, right? How do you otherwise tax Apple?
Yeah, it's an interesting concept.
Because again, if we say that, sorry, go ahead.
I was going to say, how do you tax the billionaires? Because in the end, you don't really tax Apple, because it's going to get passed through anyway to the owners. And the owners of shares are going to, if they don't sell, they're not being taxed until they do sell. So,
right, and but again, the idea that we, like you're a tax guy, right? I'm like, all these smaller corporations that are based in the United States get hit with the corporate tax, right? Whereas Apple says, okay, we're not a U.S. company today, we don't have to pay it, right? So we're not. So my point is, like, you want to tax Apple. you can't tax Apple, right? Unless you institute a tariff. Say, hey, you want to bring your products in, you don't manufacture them here, you pay another company to manufacture it, you bring that product to the United States, you got to pay a tariff on it. Now, if you can negotiate with your manufacturer to eat the tariff, okay, fine. But at least there is a receipt on the part of the United States for Apple's business that they're not currently getting. And if they want to do business in countries that are more hostile, according to our policy, right, then you pay a higher tariff. And yeah, some of that will trickle on to their consumers, assuming that they have a degree of pricing power. But they're giving a whole lot of stuff away for. We just got 3 new iPhones in our family. He got one for his birthday, and my wife and I are there. It's like, dude, they're practically just like giving them away right now. It's crazy.
Well, in the end, so whichever way we argue now, whether you think it's a tax that gets passed on or not, whether you think it's inflation that gets passed on or not, if whatever you think that is, does this removal of it change any of the costs and expenses from before? There's so many things we don't know. Are they going to give back the money?
Yeah.
Are the importers going to get a credit? Do you think that there's ever any time that you send? So years ago, since you acknowledge I'm a tax guy, so about 2002, if I remember, I was talking to the IRS, called them to talk to them specifically about a corporate tax, a corporate policy or corporate account, and IRS had sent the client a check for a few $1,000s. And so I said, what's it saying? It said it was a refund. I said, deposit it. I mean, that's what you should do.
Right.
Deposit it. Well, they deposit and spent it. And then the IRS says, hey, you owe us that and more back. And so I was on the phone with the IRS and they said, look, if you ever get money from us, assume that it was on a mistake because it's kind of a one-way street here.
Yeah.
This is literally what the IRS told me, representing a client. They said, basically, if we ever send a corporate account money, assume that it was a mistake and you need to hang on to that because we're going to ask for it back.
Dude. Okay. I mean, the tax policy is egregious in a lot of ways. Double taxation. I mean, again, we don't tax other. I mean, again, my sister-in-law always talks. Oh, I work for a nonprofit. I'm like, yeah, you're the owner just wants to make more money. Okay, tax free. I mean, the idea they don't want to pay a corporate tax. They're just going to pass it through. They got to spend it, right? It's not because you're doing something virtuous, right? Just because they're a nonprofit. It just doesn't. And then finally, we had lunch with her at Phil's Ice Houses a number of years ago, and she's like, "Man, they're just spending money on stuff because they have to, right?" She's like, she's realizing there is no real virtue to the tax structure. It's just a tax structure. They're trying to avoid taxes. They want to bump their income up. But they got to spend the money, and it's like, and she didn't like the idea we have to spend the money. I'm like, but that's why they chose that structure. They're paying themselves more. Yes, I know that's upsetting, but look, I mean, so my thought on tariffs. So I think you raise a very important question here. Is that what is the effect of tariffs? But also the ruling right now creates a major problem. Is that there is no direction. Do they have to return the money? Well, if you're, let's say, for example, Apple, and you gain concessions from the manufacturer, right? So they in essence gave you a lower price for your product to help compensate you for the tariffs. And then all of a sudden you get those tariffs refunded to you. And you said, well, yeah, I did pass on those tariffs to my consumers. Now all of a sudden you're actually giving Apple more money, right? It's actually a benefit for these big companies that actually paid the tariff, but it was borne in part by the manufacturer, borne in part by raising the prices of their products. Now all of a sudden Apple's getting all that money back. Well, how does that make sense?
Well, and do you think they're going to go contact all the customers and say, hey, you paid an extra 15% for the last year. Come get your rebate check from Walmart.
Right. I mean, this is going to have to be litigated in the court system. I mean, all this stuff's going on. It's like, there's no real way. In fact, the reality is a lot of these companies maybe really weren't paying much of the tariff, right? In fact, maybe Apple did see virtually all of those tariffs basically being eaten by the manufacturer. And to be honest, a 10 to 15% tariff, the manufacturers can easily absorb that and will willingly absorb it just to have the business. So at the end of the day, a 10 to 15% tariff really isn't an issue, really isn't inflationary at all for U.S. consumers. But the reciprocal tariffs really seem to be where the Supreme Court had an issue, saying, well, if we reciprocate and say a 50% tariff, well, you can't do that. You need a bill passed by Congress. So
and I think we ended up with a lot more questions than we did, and any answer.
I mean, they really stepped in it. I mean, obviously, there's a lot of pressure here. I mean, you had Gorsuch, you had Amy Coney Barrett, I believe, sided with the Democratic-leaning, obviously, opposition in the Supreme Court. I think you had Alito, Kavanaugh, and who's the other guy? Was on the other side of the issue. There's three that went with Trump, but Trump appointees went against him. He's not going to like that, but here's my point: is like the real issue right now is how do you give the money back? And there's no real instruction about how that happens. And the issue is that there's no way to do that. Using Apple as the poster child. Apple comes out a big winner here because they're going to get more money than they actually paid out in the tariff or the tax itself. But it doesn't really change much on the actual tariff. I mean, Trump's just going to go to a new policy. So I got a couple of things in here. Section 232. Well, there are some tariffs right now, Section 232 tariffs. Those were not touched by the court, right? So those aren't going away. But there's other tariffs that the U.S. could use, or the Trump administration could use, and could get up to 50% tariffs, which is the reciprocal. So my thing is like, the tariffs aren't going to go away. The bigger issue right now is just the matter of saying, okay, maybe the court's not as amenable to it. Maybe they might get some successful challenges. It might be more difficult to institute, but the quagmire here is actually giving back the money in this instance.
Well, and my thought is, what if companies like Costco, who did issue a lawsuit against the administration, do they get just their legal fees back? And do they say, we're not going to give anything from this point on, tariffs aren't going to happen? Yeah. But from everything before, is Costco going to win the litigation then? Because, hey, yeah, I sued and you've just vindicated me, so pay my legal fees. Mm-hmm. And do we just see legal fees covered and no refunds? I think that's probably the likelihood, if anything.
You can't refund it. I mean, and that's the issue, is that you cannot refund it without allowing these companies to benefit from the tariff, right? And can we really do that? Can we allow a company like Apple or Nvidia to benefit from the tariffs? Well, we collect all this money for you here. You just made more than you paid out, right?
Yeah, that's an
extreme moral hazard. Sorry, go ahead, Blake.
Oh, I just was agreeing. I don't think the money's going back.
Yeah.
At all. That's it.
Oh, and here's the thing about the reality: tariffs have never had to go through Congress, right? These are existing laws right now, right? So the point is there a Section 3338 tariff that gives up to 50%? And so I was going to bring up the Jazz. So I'm an NBA fan, right? So the Jazz just got a $500,000 fine, right? Because they sat Jaren Jackson Jr. and Lauri Markkanen in the fourth quarter, and they split. They went 1-1 against Orlando and Miami. So my point is that, look, I mean, the fact of the matter is they're just going to move to another thing, right? That's a very subjective fine against the Jazz. And so the point is, so we say Section 338 Tariff Act of 1930. This is a bill passed by Congress already. So we can say, tariffs, but they've already enabled them to do retaliatory tariffs up to 50%, engaging in unreasonable. And so this is the problem, right? The NBA fines the Jazz $500,000 because, well, you should have played Markkanen and Jaren Jackson against Miami, but you didn't need them because you beat Miami. You went 1-1 in those two games, but we're going to fine you anyway. So this is the issue, is that there already are laws that enables the administration to do a degree of tariffs, 15%, right? In this case, retaliatory tariffs up to 50%. And that's an issue, right? So the idea is that this is a relatively subjective ruling. Now, again, it's against a specific policy, the IA, whatever it's a big acronym, right? IAAP, whatever. But let's look at the market indications. So Blake, what have you seen just since the ruling today?
Well, let's start with gold. Just start with gold, because if it's inflationary,
okay.
If it's inflationary, afterward, you expect gold to take off and hedge. Gold's response was monstrous, huge swings. very aggressive. I think they're trying to decide what it really means from an inflationary standpoint. Gold collapsed. We don't need it. Wait, we recovered all the way back up. So the immediate response was to sell gold and push it to multi-day low again. And then we recovered all of it.
Yeah.
I think they know that, hey, this doesn't mean that inflation is going away.
Yeah, and we did have an inflation report today that was a little bit above expectations, right? The Fed's preferred measure. But this is why I say that if we actually if we take this ruling today and we say, okay, you can't institute these reciprocal tariffs, because the reality is, Obama put a 30% tariff on steel imports from China, among other things, right? I mean, in 2008, I was trying to import nails from China. That was actually 2009 after the housing crisis, and they're putting 30% tariffs on all these housing products, home building type products coming from China, raising the cost to build a house. At the meanwhile, the market's crashing, right? So the reality is, like, we've instituted significant tariffs, and again, without any sort of additional policy required here. But so my thought process is look, why is gold going up here? It's not because prices are going higher, right? Again, prices already high. Inflation is still above the Fed kind of target of 2%. But my thought process is why would gold potentially be strong here is that, look, 50% of all dollars are held abroad. The reciprocal tariff was doing what? We saw that recently with the agreement with Japan. It was forcing them to take their dollar reserves that they're holding and basically saying, look, you're going to get these tariffs if you don't invest that money in the United States, right? In manufacturing and this and that. Now, all of a sudden, we're basically saying we don't know that the Supreme Court says, well, we don't really like reciprocal tariffs that are going to be 50%. So we're basically going by feel. We're like Adam Silver in the NBA saying, we're going to strike this down. We're not going to allow you to do that policy. We're going to slap your hand. But the reality is what we've just now done is said, look, the only thing that's basically holding the dollar up right now are the reciprocal tariffs. We're keeping them from just spilling the dollars onto the open market. To me, that's inflationary. If all of a sudden these countries say, we don't have to negotiate with you anymore, we'll wait this out in court. The Supreme Court's going to strike it down. Now, all of a sudden, you have no hand from Seinfeld, right? George Costanza. You have no hand in this relationship. Now, all of a sudden, we're just going to sell your dollars. We're going to sell your treasuries. We're not going to hold on to them. We're not going to invest them in the United States anymore. I think that's a huge hazard for inflation.
And what does it do to the interest rates? So this is stagflation all over. I talked about it yesterday in Thursday's video. We are set up for stagflation. If we see them dumping bonds, like that chart shows, then interest rates go up. Small caps get clipped. I talked about it in the video yesterday. Financials won't be lending. So I'm betting against financials. I'm betting against small cap. I don't care that the spike happened, because interest rates, if they go higher because bonds are being sold off, borrowing costs are higher, borrowing will be less. So the banks make less. And IWM is kind of a double whammy, right? Because you have the Russell that has a bunch of financials in there. And the small cap. So you kind of get a double whammy off financials and the Russell. So I don't think this is good. I don't think it looks good at all.
I mean, inevitably so if we say small caps, if we assume that they're mostly US based, a stronger dollar benefits them, right? A weaker dollar benefits multinational companies, which is your S&P 500, which is near highs right now. And so you're really seeing this play out, that again, if we're going to see a bunch of dollars spill out into the market, whereas before they're holding on to them and saying, hey, we're going to take these dollars, we're going to do measured investments to allow the U.S. to manufacture domestically. They're investing in our manufacturing. Now, all of a sudden, hey, I don't have to do it. I'm going to stick it to you. We're going to sell your treasuries because you want to be savings based. You don't want to keep taking on debt. You want to raise your savings in the United States, which isn't happening yet, by the way. But you want to produce more than you consume. Forget it. We're not going to facilitate basically allowing you to balance out trade, which frankly, we've had the best balance of trade we've had in a very, very long time, just in the last number of months here. So again, we're not going to facilitate balancing out trade. And as a function, we're going to just sell your dollars, right? We're going to sell your treasuries. And so this ruling today is really stepping in it, and it's not bullish for the market. That's my opinion. Oh, Blake, you're on mute.
Sorry, I just trying to make sure you don't get any background noise. I agree with you.
Blake doesn't want to let us hear the waves. That's the problem.
Yeah, I don't want you to be.
So if I'm quiet, you're gonna hear paradise. I
am literally 40 feet from the waves. So, so I agree with you. I think that this is not good for the markets. I don't think. Let's assume that it was, hey, tariffs hurt the market, hurt the consumer. Undoing the tariffs is going to be positive. The costs associated are still going to be an issue. The higher interest rates are going to be an issue. Inflation is still potentially an issue, but it's stagflationary. I think it's inflation without growth. I agree with you 100% on that part of it.
Yeah, and a lot of people say the tariffs are
costs are too.
Yeah, and a lot of people saying the tariffs are going to be back. Yes, but here's the problem though, right? So again, we've already allowed judges to step in and create an injunction. But again, some of that injunction is based on the likelihood they're going to win in court. And so the issue becomes is that you're going to have, judges that are fairly like activists, right? I mean, these people are not, a lot of them are not really that objective, especially the lower court. And then all of a sudden they put an injunction, they go to a higher court. Now the higher court's looking at this ruling and saying, oh man, well, they might actually win, right? And so now all of a sudden it does put it more, it's going to take more time for any sort of tariffs to get implemented. And so it just creates barriers. And maybe the choice was to go with this particular policy or this particular bill to support this current thinking. It's the weakest of the weak. We got stronger. I don't know what the thought process is there, but it doesn't strike down all tariffs. But again, it does make the reciprocal tariffs more difficult. And those are the ones that are reorienting policy, forcing reinvestment in the United States, as we've seen with Japan, for example. Now, some of these deals have been inked, but good luck getting something done with China, probably. That makes it more difficult there. So I closed out my China spread, even though it was prematurely. We lost a little bit on it, but I'm like, man, China might make a move here. Weak dollar, removing tariffs. I mean, China might be the big winner in this ruling, and maybe some of the emerging markets, but EM's mostly weighted towards China. We're seeing a big move here.
Since you got China and you're talking about that too, I mean, China is one that will quickly move and say, well, my costs, I'll do sunk costs. Well, forget it, it's gone. And if the reciprocal and already have facilities in Mexico or in Brazil, I'm just going to move my stuff there.
Yeah,
I'm not going to give you the extra benefit both sides. I can quickly adapt and move it to Brazil. I can quickly adapt and move it to Mexico, where I don't have the same restrictions.
Yeah, and the reality is that, I mean, the Chinese manufacturers are not going to, if there's any tariffs, like for example, we manufacture product there, we buy it from the manufacturer, we ship it to the United States. The manufacturer, if they made some concessions, they offered a cheaper price, they're not going to get any money back, right? It's only going to be those that brought the product in. It's the middleman, right? Apple is a middleman in this process. They don't make iPhones. They buy them and import them. And so the only benefactor there, it's not going to be the Chinese manufacturers. It's going to be the benefactor of giving the money back is going to be to Apple. But I'll guarantee a lot of these Chinese manufacturers are eating those tariffs, and it makes it better now because, they're not going to have heat. And a lot of these, like a K-Web, for example, we're not seeing as much benefit here for like internet. But if we look at FXI seeing a bigger reversal here. These are the 30 biggest companies. So again, if you're actually bringing products here, they're not subject to tariffs. You're not going to benefit as much. But if you are, the bottom line certainly gets a little bit better here. Let's look at like NIO, for example. This creates an opportunity for some of those electric cars.
Mm-hmm. Yeah, they're actually good looking. I think they're better looking than others. We'll just leave it at that.
They're interesting. Yeah, the Cybertruck sucks. I hate it.
It's so hideous.
Luke, what do you think about the Cybertruck? Do you like it or not?
Oh,
he doesn't like it either.
Good for him.
He's
smart.
Now, if I was like 1980s Chuck Norris watching Delta Force, okay, I might be into a Cybertruck. Yeah. Like if that was like the I can't remember what year that came out, but if I was watching Delta Force with Chuck Norris and I saw the Cybertruck, I'd say, hey, I might actually like it. But today, no.
or if you're a big fan of Mad Max, the original.
That's Mad Max too, right? There you go. But Delta Force, they had these motorcycles that were kind of had that similar kind of geometric kind of shooting lasers, and Chuck Norris. I mean, it wasn't like that. All right.
So let's go back to you. We already looked at Apple. You threw Neo in here, but let's shift to Costco and Walmart. I want to talk about Costco and Walmart.
Steve says, "Love my S. Cybertruck is ugly." Yeah, but the S even is a lot of the designs are just old, and the new Roadster. I'm like, give me a break. The original Roadster, Tesla Roadster, was good looking. It was on Chuck. This one, I'm like, really? No wonder. All right. So Costco or Seal the answer. So Blake, what's the follow through on the tariff discussion with Costco?
Well, I think you can see that I think it looks like we're pivoting right where we're at. I've been waiting for Costco to give us a pullback. I think that sets them up. I don't think their earnings are going to be bad. I think they're going to probably have good earnings because they've been doing a lot of cost cutting measures. But that candle today is saying, hey, we kind of put in the base. No matter how this plays out, I think we've found the stability. Either they're going to save money on litigation or not, one way or the other, that they're going to be able to stabilize at this point. So I actually like Costco as a buy, or even just as selling puts or put verticals down here, because I think it's set up for a really good opportunity. And I think they're going to be out of the cost increase, at least the punitive ones, and the reciprocal punitive ones, because that's why I say the reciprocal. They're punitive, flat out punitive. So at this point, I like Costco. I think this is the pullback I wanted to be able to get a little bit reasonable price to own Costco again.
Yeah, I mean, Costco used to have like get stuff really cheap, right? They used to sell like polo stuff and that because they go to China and say, oh, it's overstock, except for I'm buying it from the manufacturer under the table and selling it on my. So they got rid of that. But yeah, I mean, look, there's an effect here that, again, and even from a trading down standpoint, right? I mean, Costco, you can still get the $1.50 hot dog and drink meal, right? I'm like, you can still get.
And we know that their hot dog meat is imported. Wait, just kidding.
What? It's not.
I'm just kidding you.
I think most of our meat's imported, unfortunately.
That's probably true.
Yeah, we have a local meat company, like, oh, our prices are competitive and it's all locally sourced. I mean, you go out instead of like getting those, like, we'll send our meat abroad and we'll import cheaper, less control, whatever. But I think you're right. I'm like, as we look at Costco, I mean, the reality has been a lot like VFC, for example. I mean, VFC actually beeped, the stock dropped, right? We played this one because it was huge put activity here. Then it rallied back up. We're about to break out today. I mean, those that are actually manufacturing clothing and stuff, it's hard to get away from China, right? And so the reality is, I mean, what about Nike, right? Nike manufactures a fair amount of shoes in China. Huge breakout today in reversal, which is kind of interesting here. But there's an attempt to break out right now in a lot of these names. The question is, can they sustain them? And I think you're right, is that as we look at the canary in the coal mine, we go to TNX, CGI, the canary in the coal mine is interest rates. The fact of the matter is these companies are heavily indebted. You look at the quick ratio and that, I mean, how can they meet these debt obligations and other obligations over the next year, strip out inventories? And again, yeah, we're saying, yes, we're going to give you some cheaper products, which are probably the manufacturers eating anyway, or a large portion of it, like a Nike, for example. But now all of a sudden we're going to add in higher borrowing costs. And so to me, this is going to be more inflationary if we actually take down the reciprocal tariffs. The 10 to 15% is not a big deal. I don't think that I don't think the Supreme Court's going to care about a 10 to 15% tariff, maybe even a 30%. But you get to the 50%, kind of that 10 to 15 plus the reciprocal. But to me, I mean, if we really take this down, we take away the threat of a tariff, you're basically welcoming much more inflation if dollars are sold and interest rates go up.
Well, and you talk about that this is one of the many canaries that we look at, but even Nike, I always treat Nike like consumer discretionary minus Tesla. Tesla should not be in consumer discretionary as far as the index goes. So Nike, I'm just confirming what you're seeing here. Why is Nike not benefiting from this? Because the consumer is not going to benefit from this. Nike's chart has about an 85% correlation to XLY minus Tesla. And so that, I expect that. I don't expect the consumer to suddenly come out ahead on this move.
Yeah.
And so the canary in the coal mine, higher interest rates, higher costs for consumers, higher costs for businesses, higher costs for tech companies borrowing, whether it's ed, small cap, all those higher costs. It just shifts the tax now as an interest rate instead.
Yeah. And again, to me, this is a much bigger story, is just, again, the effect on, again, if we start to sell dollars, right, that's going to create higher inflation as those 50% of all dollars are held abroad. If those start to come back, not in the form of investment, they're just basically getting sold in the open market and maybe converted to gold and silver. I think the biggest benefactor right now, as far as upside opportunity due to the strike down the tariffs today, is gold and potentially silver. And so again, if you're bullish on something, I don't think it's going to really be borne out in the S&P 500 being extremely positive if we're seeing selling in treasuries, if we're seeing selling in the dollar. Again, I think it's going to be gold and silver going to be the biggest benefactors, and maybe to a degree oil, but oil's already made such a big move. We may see a little bit of a pullback here, but we may really regret, again, everyone talking about tariffs being inflationary. This is actually could be a lot worse, because from my perspective, the tariffs help hold in place the dollar as a reserve currency. Granted, it was by threat of reciprocal tariffs and getting a deal done and bringing those dollars back in form of investment, not just selling in the open market. This really removes that negotiating tool and does create an environment where they do sell dollars potentially more aggressively. We're not seeing it against the euro right now. If we look at the US dollar, Japanese yen.
I was going to say, let's do the dollar yen. You're going to get a representation of all of Asia with
all
that.
of Asia, right?
And
there,
then the
just
Aussie
flat.
yen.
Then the Aussie yen
will get your metals, gold versus the yen.
So Aussie should strengthen there. So we're not seeing any broad-based selling of the dollar today. We are seeing it, though, in treasuries. We're seeing a decent little sell-off today in treasuries. We saw it on the news. But again, this is a big threat for the market. If yields start to go up, it's a threat for borrowers. If we look at ITB, and it's crazy, look right here, for example, we popped and we realized that interest rates are going up as a result. Right now, we're really crashing right now, but I'm disappointed how much the market's dried up in ITB option market.
Yeah, the options have really been bad. I used to love to trade ITB.
Yeah, ITB is just like me. You see
I
a
prefer
little
ITB
sporadic
over XHB significantly. Now it's sporadic.
More focused. Yeah, but it's crazy. ITB's just really dried up on liquidity. Even XHB is not amazing. I'm like, it's just the market to be able to trade these downsides really dried up here. Spreads are really, really wide. But this is not going to be good for home builders.
Here's a question for you. I mean, and I've been very bearish home builders for sure, but and I've been waiting for this, but I think this could be the final top for ITB for a while. We could easily see it drop back into the 82 level and maybe even lower. I really think you get annual lows here. But my question for you is, after all that's been said and done, after the Trump thing or tariff has been struck down temporarily, what ghost prints kicked in? I don't mean to push it that way if that's not where you're ready to go. Well, there should be some high volume stuff, right?
Could be, right? So I'm going to reset all filters. Right now, there's 648 pre-screened results, both selling and buying. We see the selling because we're looking at spreads as well. But if I go to block trades, we can kind of see 36 for this time of day is quite a bit. So we just look by vol alert. What's the highest? They're buying puts today in LQD. So, I mean, think about it for a second. 49.9. So we just click on the squeeze bar. We click on the location bar. Someone bought 49. These are way out of the money stuff, but 49,000 put option contracts in LQD. And again, this just really kind of puts into perspective that if treasuries are going to sell off here, we have very tight spreads between corporate bond yields and treasury yields. So if treasuries sell off, it's going to affect stuff like LQD. And somebody's taking a way out of the money bet at 10 delta here, but 49,000 contracts bought in one trade. That's a decent sized bet. And what was the price on it? The bots paid 6 cents. So notionally, it's not a lot of money, but in actuality, the effect, if we start to pull back towards this level, could be relatively significant.
And that's a big bet. It's like the guy that used to buy the 50-cent guy that used to buy out of the money VIX options.
Yeah.
Might be a good trade too. Buy some VIX options.
And this isn't a hedge because that's a 10 delta, right? I mean, they're just buying way out of the money. Just, hey, this thing might go from 6 cents to 30 cents, right? To a buck. But the point is just that, I mean, as we look at LQD, these are borrowing costs for all these companies, right? That are you know, they're not junk bonds, right? They have good credit rating. But if we start to see this roll over here, realize this is not a very liquid market. I mean, you go back to April of last year, we went from 109.50, dropped to 103.50 in a matter of days. So realize that, you know, with Owl and that Blue Owl fiasco going on, realizing there's no liquidity in the private lending market. Go figure, who would have thought that? You know, you look at HYG, these are your junk bonds. There's never liquidity here.
Well, you know, and I know it's not the same thing, but private equity is going to, they're going to be tangential, right? Private equity groups are going to be tangential because it's a variation of, it's not lending, but it's a variation of capital structure.
Yeah.
And
private equity, so, the reason why they can come into these companies, say, hey, we're gonna put in X amount of dollars because they raise debt, right? They have access to these private credit markets like Owl, for example, that are facilitating. And so this basically is a reflection of private equity and the amount of return on investment there, which isn't great right now.
Yeah.
And there's no liquidity.
Throw BX in there. Look how bad BX has done.
Yeah. So
I mean, talked about this yesterday. We still have more downside, and we're about to clear the annual low. This is not good for private equity. It's not good for lending. It's not good for financial. It's not good for any of them.
Yeah, absolutely. Right. And again, we could readily test our lows here. So right now is like, we think about, oh, well, banks are well capitalized until when? Right? Until they're not. So the reality is banks are never well capitalized. Right?
Yeah, at the end of the day, even if they were, they don't make any more money if they're not lending.
Right.
So if they stay well capitalized, then they make no money. Then they have no earnings. Why would you bet on someone with no earnings?
But the reality is, say, okay, but that's based on our investments are here, and we don't have to mark to market. But people know, right? When the actual assets that are on the balance sheet, they know if they're losing value, and they're not going to give them $1 of book value for price, right? They're not going to give them the same. And then they start to slip to like a 0.5 price to book value because they're saying your book's not worth what you say it is. And right now, banks are trading at much, much higher multiples. And so while they appear to be well capitalized, once the book value of those assets, they're not going to tell you, but the market's going to run the numbers and they start to say they're worth less. And one of the biggest banks right now that are threatened by virtue of selling in the bond market is Bank of America. I mean, they're now with Silicon Valley Bank gone. I think that was the company, the bank, but now they're like the poster child for treasury risk.
Yeah, the person that bailed out, the person that couldn't bail themselves out is now exposed.
Yeah. And so the point is, like, you start to see selling the treasury market, Bank of America's balance sheet, which holds a lot of treasuries, is going to start to get hit. And so again, if the tariffs create additional selling, and we saw an IEF the other day buying 20,000 puts in IEF, we're seeing this trade build on the downside in bonds, and especially in corporate bonds for the last month. My HYG trade's gonna expire worthless today, but I just needed to break 80. Didn't happen. But the reality is, this thing, when it breaks down hard. This crashes to the downside. Bonds crash to the downside, especially corporate bonds. So again, looking at that trade in LQD, just reflective of the fact that, look, there's significant downside risks right now.
Yeah, and even Don's jumping in saying, "Sell, monkey, sell." Got to remember, all this stuff, this isn't fear mongering. This is preparation. It's reading the tape. It's reading the tea leaves. It's understanding how economics work. This is opportunity. This is not, don't be afraid of this. This is opportunity. It's repositioning. It's avoiding high risk and taking advantage of sell-offs. And right now, look at that. That's a crazy good double top if you're trading intraday.
I'm watching this. I was waiting for this to crawl back to 689. So my dead zone. It was outside the dead zone was right here about 685.50, and I'm waiting till 10 o'clock my time. It was down here. We rallied to 689. I was pricing out with my son. I'm like, okay, if it gets back to 689, it went. Unfortunately, now we're unwinding. I'd already be out of like 100% gain. Dang it! I'm like, anyway, I should have been paying attention there because that was the time to put it on. Right there at 10. We kind of came off it at 10, but We may get back again, right? But again, just realize this is not everyone that's been crying tariffs being bearish for the market. Yeah, there was an adjustment period, but just realize that the threat to the dollar is inflationary, because if people sell dollars, that devalues the currency, the purchasing power goes down. That has a very direct and immediate effect on inflation. Tariff, not so much. But really the threat to the bond market due to selling initiated by Treasury spilling over from there. But let's see if we got anything else. So we got to LQD in
Will you
here.
throw
But
TLT longer term after you get done? You can go.
yeah, let's
You
do
can
it.
do what you're done.
No,
Okay.
we'll come back.
So
There's an
asking
SILJ
about
one in there.
TLT, and we'll do more than, yeah, not just intraday. 'Cause I think this is what we're looking at. And I mean, is today the bounce down? I think we're gonna probably try to push higher until we get some information. But I think you're right. If the other countries say, okay, we had to do this before, we had to hang on to it before, just to protect ourselves. Now we're getting out of our risk. And if the bond vigilantes step in again, I mean, that, it's not huge, but what if it clears that low? What's to stop it at that point?
I mean, the trade balance dropped to like $20 billion, $28 billion or whatever it was. And then
we've never seen that in 25 years.
Right. This couple decades, right? So meaning we're not borrowing as much money from the world. We're borrowing a lot of money, but we're not borrowing as much of the world directly, right? In terms of goods. And the next report was like 50 billion. Well, it went up, but it was mostly based on what? Bringing capital goods to manufacture in the United States. So it's like there was real progress on the idea that we are going to manufacture in the United States. We were seeing that trend. We're seeing the investments. It's going to take a while for that whole thing to play out. But we first saw that initial bump back up in the trade deficits. We're bringing capital goods that we can't manufacture in the United States to manufacture more here. So look, we do know that Trump wants to manufacture. We do see that we want to save more. And so as a result, these countries, if they see the writing on the wall, why wouldn't they? The dollar as a reserve currency, if we begin to manufacture, we balance trade, it's not going to be a reserve currency anymore, because we're no longer borrowing that much from China, borrowing that much from Japan. It balances out. And that means what? Their dollar holdings are going to get devalued. And we have no control over how those dollar holdings are invested. And that creates a lot of risk and uncertainty. And again, the market's up 0.25% here, but just realize that this is not necessarily a clear-cut sign we should be bullish on the market.
Yeah, and we might just stay here. I don't know if we're in that range. In fact, I'd say probably dead center, just because I think, expiration Friday, I think people know we don't really know. We don't have enough information.
Right.
So
you need to see again, does the bond market sell? Yeah, if it does, then we know that's going to have a carry-on effect. Technology companies, for example, are going to be affected if yields pop to 5%, right, on the 10-year. We know that the housing market, we know a lot of stuff is going to be affected here. Now, if we kind of circle back around to 689 again, looks like we're kind of breaking right now, but if we circle back to 689 again, this was the trade I planned to talk about, and I just missed the opportunity. But if we get back to 689, this is what I'm looking to set up again. It'd be right here, just buy deep and wide, 1 month, 2 strike vertical. We're falling back into that dead zone right now. But if I could get this for 50 cents, 0.5, okay, we'll just create an opposite order here. And just, this isn't necessarily a set it and forget it, but you can use another product like use XSP, for example. If I can get in at 50 and out at $1, that's the trade. But we this range has got to hold. We got to head back up here again, but we're not. We're breaking some support. We're seeing some selling in it right now, which again makes sense.
I was wondering, it broke.
Yeah, makes sense, right? That we're seeing this pressure. So again, for those that are cheering the tariffs being kind of struck down, just realize there's a lot of bigger implications here that are not exactly bullish for stocks. So the big question is this? We've seen the issue being that volatility has remained elevated, right? I mean, the VIX has been hanging out at 20 as we've been sitting in a 3% range for over a month. So we're seeing higher volatility because we're seeing larger intraday moves in the S&P 500. So if we go back here, so a professor brought this up, but we'll just bring up the also let's go here, ATR study. We'll say okay and apply it. As we've gone through this 3% consolidation range, the daily ATR has gone from 57, now it's at 79. So as we're basically stuck in a consolidation, the daily range, that's from the previous day's close, the next day's high or low, or the range from high to low, whichever is greater, has actually expanded 20 points over the course of the last month. I mean, this is not a bullish sign.
Huge volatility.
Yeah. I mean, this is a big bump as the market's doing nothing. So ultimately, you're getting robbed in terms of your movement in the market, but you're paying a premium to buy options, right? And even during this phase, the skew has actually diminished a little bit over this last month. We're not necessarily talking low levels, but you're not even getting it on the skew, especially on some of these short squeeze trades where you have typically positive skew, where you have rising call volatility. That's come in a little bit. And so it's just gotten a lot more expensive over the last month to trade options, except intraday.
Well, and to be clear, when you say more expensive, it also means that you can't just instantly sell it. The spreads on the bid and the ask are so wide, it's expensive either side. You're either getting paid underpaid for selling or overpaying for buying.
Yeah, exactly. Don says he still watches Seinfeld. Did you catch my Costanza reference earlier? Trump just lost hand. And this is not the episode about the bet. Sorry. So the point is, look, we're seeing retracement here again. If I get back up here, I'm definitely looking at trying to execute a trade, something like this. So you could just hang that out there. If it fills, it's going to go one. And if you're about 30 minutes before the close, look to close it out if you have some, more than 50% of value. But your broker may close you out if you don't. But anyway, the point is, this is fading right now. It makes sense. Initial reaction isn't there. But again, let's go back to emerging markets. FXI fading a little bit. EM maybe fading a little bit here, but overall, it is more positive for emerging markets than it is for U.S. stocks that are heavily indebted, right? And U.S. based companies, which a weaker dollar, which we're not seeing a lot of weakness in the dollar right now, but I think we could. Anyway.
Yeah, here's I know it's
Brian said SILJ. Yeah.
Go ahead.
Yeah, there's a print. So we talked about SILJ the other day. But notice what they're doing in SILJ today. There's a few of these going on, but I mean, look at this, right? So Blake, if we consider this, so a call, you got basically 15,000 close to 15,000 contracts, both at the same time. One fills near the ask, the other fills near the ask. What do we call that? Call, put, both getting filled near the ask.
Well, are this? I can't.
Different strike prices. Different strike prices.
Then it'd be a strangle.
Yeah, they're buying a strangle. And why would you buy a strangle, Blake?
Because you don't know what's going on, so you're betting big that it does something. Don't care what it does, just do something big. That's all I need. And
you're also saying ball's low, right? So let's take a look.
And a big move's coming.
This is for next week's expiration, right? And so if we take a look at SILJ right now, let's do some volatility analysis. And normally a strangle is, again, you expect a big move, volatility is low. Let's look at option statistics. We're in the 55th percentile and realize that this was during a very speculative rally in silver stocks where their volatility went to 98%. I would guess that's probably historically very high. So let's take a look here. Where are we going? Up one more. So at 99%, I mean, we probably have not seen that level of volatility for a really, really long time. You'd have to go back to 2021 maybe. Mm-hmm. So right now we're in the 55th percentile range, coming off a level that might be an historic high in SILJ, and they're buying a strangle. And the strike prices they're trading in this thing are what? 36 and 34.50. So 36.50 is right there. 34.50 is right about there. So it's a daily chart. That just seems like volatility is low. when I'm looking at that's within today's range almost. But in essence, they're saying, yes, we've come off. The actual volatility is not. Historical volatility is at a high. This is going back 252 days. That's not perfectly representative here, but the point is the volatility is actually high. Implied volatility is going low. and relative low. So that spread looks pretty dang cheap right now. 36.50, 34.50. Man, how much is that costing right now? We can recenter if we want, but
let's see.
So for Feb 27, this is for next week. Basically costing you about $1 there. 36.50 is costing you about, let's say 70 cents, 72 cents, $1.72. You just basically need this thing to get 34.50. This gets down to, 32.80, 32.70 down here in a week. That seems pretty
Seems
reasonable.
like a reasonable bet. Yeah.
Yeah. So here's again, a 15,000 contract trade. And so you think about that, right? So 15,000 contracts roughly. I'll just show you the time sales down here so we can stay on this page here, but 27. Now this is a roll. So they close that out for about 16 cents, but they put that on for about $1.70 times 14,990. No, actually 29,990 contracts, right? That's not a small dollar amount, is it?
No.
And they only got pennies for closing out that one. And they did put on a 27 Feb. This will be a roll here. Maybe a short put on that one. That occurred at the same time, 27 Feb to 20. So they did sell some puts out here at 32 to pay for it. Pay for some of it anyway. So bought, sold, right? So this does have a slight upward bias on the bigger move side. So they're saying, hey, we don't think we're gonna go below 30. That 30 strike? It's 32. So in essence, what this is reflective of, let me just clear my studies out. What this trade's reflective of, saying, look, we're going to sell 32s, 30K, right? We're going to buy 34.50s, 15K, and then we're going to buy 36.50s, 15K. This has an upward bias, right? Unlimited upside potential. There is risk below 32. So this is a bullish trade net on silver, which kind of plays into what we're seeing right now and what we're kind of estimated stagflation. But in the idea of gold too, the more stagflation we get, probably the more positive it is for gold and silver. But this is basically a trade. So we're going to sell down here to help pay for this, take the edge off. And we're just saying this thing uncapped the upside. We don't think it's going to go below 32.
Yeah, that's still, I agree with Ed is that it's probably relatively not, it's not cheap, but it's a well-positioned trade that your opportunity of it really going one way or the other.
Yeah.
Not a lot of exposure there. So
yeah.
Volatility is relatively higher over the last year, but
yeah. And look, you one way you can trade silver without, again, there's the crash risk of the market. If we see a crash, we see the bond market really crash, dollar's going to strengthen just because there's a lot of dollar denominated debt out there that has to be repaid in dollars. And so suddenly those dollars become a hot commodity in a credit crisis. But absent that, chance for silver to go higher. We had some bullish trades in let's go back here. This is SILJ with which they're trading silver stocks. But there was bullish trading activity over the week. I forgot I was going to show. But a way to trade it though. You look at rising volatility for the most part, you move out of the money. You don't want to take a lot of directional risk. You have the upside opportunity. You could just go like a 36, 38. Just buy deep and wide, 1 with 2 strike vertical. You go wider if you want. It's a 70-cent debit. If you get to 38, you're out. You're done, right? And Corey's ready to come on here. So get to 38, you're done. Make 70%, you're done, right?
Yep. Right. Hey, really quick, Corning, will you throw that on there? I was looking at it earlier. Corning had a really good move. I was just curious where we ended up.
Yeah, breaking out of here. Little flag.
Yeah, a little bull flag on Corning. It's hard to chase it at the record highs, but that looks good.
So I look at, like this, we had this, the trend went flat for a while. We had our first leg, little consolidation breakout. So I measure this just little seed wave right here as a projection. So again, this is a pretty extended move. We're at the 423.
Yeah, it's overextended. It's hard to want to chase it, but I saw that as a pretty good breakout after that consolidation.
It is. But I like
no volume though.
No volume. Yeah, the volume's light. But so if we look at gaps, right? So this is your first leg consolidation gap right there. And we got a small gap in here. So again, later gaps are often ones that have a tendency to break. But yeah, watch this. If we finish to the high, maybe take a little swing out of this. If we were to kind of measure, just take a fib projection, just taking this leg, just start at the end of the move, go back to the beginning. It's just a way to systematically set targets. Just look at 148, 1 to 156 in here. See if you like it.
I think it could be interesting, but careful on that one because it's pulled right back to that high on low volume. So
yeah, very late in the trend, lighter volume, early gap, later gap. Later gaps oftentimes have a tendency to not a huge gap there, but a little one. People asking for the monkey bars for SPX and IWM. Is that on the?
You know what? I'll have to pull those up because we'll want to do the end of the week because today you're not going to chase that down. I have it on the Russell, and so the Russell futures, but you know the low or the low side target for the Russell would be 2652. But anyway,
we're below it right now.
Yeah. So that means you duplicate everything and then look for another potential $30 point drop. If this can sustain that close below 52, you can get another 30-point drop and go down to 22.
Yeah, and if we take IWM here, just kind of show you what. Again, it's like I hate the fact this just just reversed so fast, but the dead zone, the expected move we're trying to take out of the market out of IWM is 250. So we have the dead zone at 265 and 262. I was wanting to go short up here. I was predominantly looking at SPY because it was the most overextended here, but in IWM. But right now we're back. We're just falling out of the bottom side. So if we get a sell-off down here, if you look for just an extreme move, you could take a bullish trade in IWM as a spread trade. But again, I would just want to see things get a little bit more extreme on a 5-minute basis, which we're pretty extreme here. We are below the dead zone just barely, but if we kind of break this and head down further, that could be a nice reversal play back to the upside. And one of the advantages here of playing spreads, go to charts here. So if I go to product depth into IWM, we'll look at the options market on an intraday basis. There's not much skew. Dang it. There we are there. So notice that this is today's expiration. You don't have a lot of skew, right? This is a, you can play a long call spread. You can play a long put spread. You don't have the issues you have at 30 days of having negative skew. You really have a very favorable volatility structure to buy here, sell there, or buy here, sell there on an intraday basis for long verticals. You can see on the volatility here. So you don't have to worry about skew so much on an intraday basis. Vol's generally rising there. It's kind of falling there. I don't know, whatever. You can get out here just the way I go out the money. It's not super. That pricing is not amazing. Yeah, surprising. Yeah.
Yeah, another comment about rare earths. I would assume that rare earths are going to have less impact because they also got the big exemption because we want rare earths. So I wouldn't expect as big of an impact to this.
But I was disappointed in CRML, right? And all that hubbub in Greenland, that's back down again. But yeah, but you can look at TP, not TP, it's TPW. Oh, what is it? I forget now. LAC, yeah, really benefiting today.
Well, Corey is in the house and ready.
All right, Corey's in the house. How we doing, Corey?
Good. Yeah. Expect to move the profile, tariffs, GDP. What else we got? CPI.
Corey's in another paradise. It's called
What's
Hollywood.
that? Was that Brendan? I didn't hear you.
Corey's not quite with us yet.
Can you hear me?
Oh, he's talking. I can hear him.
Oh, there we go. Oh, I can't hear.
I was like, I was just babbling.
Oh, I heard you.
That's kind of odd. My AirPods took over.
Blake can hear me. Anyway, tariffs, GDP, and inflation profiles, intraday expected moves. It's just a party over here in Hollywood.
Yeah. How's the weather?
Yep.
It's cold. It's gray.
Really?
It's that sun. I want the sun back.
Yeah, it's only 82 here.
Where is that? You? You're in Florida, right, Blake?
No, I'm in Mexico.
Oh, beautiful.
Yeah.
Oh,
Johnny's in Florida.
I'm going to catch a flight, so I'll see you guys on Monday. Have a good one.
All right, thanks, Blake.
So Corey, I went to the Duran Duran concert out in Palm Desert.
Nice.
And sat next to a couple that just moved out there from it wasn't San Juan Capistrano, but again, maybe Dana Point, somewhere right there. And like this, oh, I just don't like the gloom. I'm like, you're at a beach, man. Like the gloom, who cares? You can drive inland if you have to, but the desert, really? Palm Desert? You'd rather be out here? It seemed like they were conflicted though. I mean, you moved from like literally one of the most amazing places in the world, like Southern Orange County. No, actually, they're Newport Beach. They were
Beautiful area.
But I'm like, who cares about the June gloom, right? I mean, really?
We get the June gloom. That's the thing. The June gloom in Los Angeles as well. Just kind of cloudy. It's what is it now? February. So a little bit early there, but it's got cold stuff too. I'm not used to this. I didn't move here for the cold. Cold being 50 degrees, by the way.
And the desert's hot. I mean, you get a Palm Springs, Palm Desert. I mean, that's like Don's like Duran. It was a present for my brother-in-law. And again, I wasn't a huge Duran fan. I do like them, but I'm not like a fan. If it was Spandau Ballet, it would have been amazing. Like they were 45 minutes late. You know, the keyboardist Nick, I forget his last name, my blank, but he was apparently little slosh from dinner. But I'm like, I'd wait for hours for Spandau or Roxy, but for Duran, I'm like, you better get out quick. Yeah. It was good though. They did really well. I'll fade away, let you radiate. Corey, have a good one.
Awesome. Thanks, Brent. Have a good weekend. Let me know how you're doing. We'll get started about 1 minute. Now, we got a lot to cover in today's session, and we've been on the intraday logic. The high of the day happened to be people got some shorts up in here. The NASDAQ's expected move. So that's happened to be, and I always do this when I'm doing a mastermind. I'm very in tune with the market gods, and I email them, I call them, I send them a little text message or something. And I'm like, hey, market gods, we're teaching expected move in the mastermind. We're focusing on expected move. Can you give me a little setup today or tomorrow so I can sort of underscore the point? We can teach it, watch it happen. 251114 in the NASDAQ, and S&P similar, but I don't know about you, but that's a pretty good little, I mean, granted, this is how market expected moves work. No magic numbers, playing short against it, playing puts against it. Again, good little lesson in application of a strategy, live trades. People did play short against it, be they scalp, be they bold hold. So that'll be the first thing to talk about. But CJ was getting shorts off the shorts 6920 in the S&P. Of course, I was a little Russell Bull. So anyway, the Russell Bull, because it was a range. But we got a lot more to talk about than the intraday charts because there are three major headlines. And the three major, can you figure out what the three major headlines are today? What are? Hey, Captain Obvious, can see you. Hey, CJ. And yep, it'll be good. So what are, I'm going to jump you up in chat here. What are the three major headlines? I'm just focusing on three because there's a lot more than that, but there's three of them. And they're moving the market in very different directions. That's why we're getting this type of range behavior. But there are three headlines. What are they? Well, and that's one I wasn't looking at, but Google, that's why I want to highlight things with you all. Google does have a headline news today. Google's got to buy the dip. Bullish on Google. That'd be a trade logic on Google. Yeah, let's put that in chat. Well, that's, yeah, tariff. Yeah, there you go. Yeah, Dale. Hey, Dale. PCE, which is your inflation data, and the SCOTUS, which is your tariffs. Well, okay. That's why I asked the question. I told you there were three I'm looking at. But there's more than that, so we'll put this in chat. Again, there's lots of opportunities. We're going to talk about opportunities, trade setups, trade logic, and how things are playing out on the big picture. So, I mean, number one, not to tariff, which is the Supreme Court. Illegal refunds. So that's kind of, let's take it one by one. One by one. The tariffs as instituted were illegal per the Supreme Court, 6-3. Therefore, will they refund? You know, and the going thought process, we had talked about it, Brandon, I think all the instructors had some way to talk about what's going to happen. My thought process is very simple. If the court overrides tariffs, the market is going to go up. That's happened. Supreme Court overrules tariffs. Market goes up. Okay, we got that. And a very, very quick little note. But again, there's multiple things going on. I think if just one little headline here, Supreme Court knocks off tariffs. Boom! All right, there you go. See, that's what we thought. Boom. That's what led to some of the intraday trades in the futures room, but that's not the whole story. The other one is, you're right, GDP growth of 1.3%, which is less than or lower than about the consensus at 3%. So that's on the one hand bearish because we're not growing as fast as expected. But is it? Because that means the Fed can have leeway to lower rates to stimulate growth. So that's kind of a, you know, cuts both ways type of thing. But it's a fact. We got to go off the facts here in TheoTrade. So GDP was a little bit weaker than expected. That was pre-market. That sent the market down a little bit, of course, overnight. But that was kind of overall. But again, is it a bull? Is it a bear? Is it a plane? Is it a bird? I don't know. So a little bit of a cuts both ways type of thing. Well, the other one was your inflation data. And that one came in pretty sticky or pretty solid at about 3-ish% on inflation data, PCEPI. And that's not bullish, not super bearish. Fed kind of can cut rates. So that's the three things we're kind of walking up into in the market, not to mention some of the other things such as AI, Google, and what else did y'all say? Iran. I mean, that's a whole other kit and caboodle there. I mean, I don't know. Maybe the Supreme Court decision does increase the odds of a strike on Iran. But if that's the case, oil is going to go up. Bonds would probably be a little bit different there. And defense stocks, we had talked about that. Probably, again, other instructors have talked about opportunities there in the grand scheme of things. So bullish of oil, to an extent bullish of gold, and bullish of things like Northrop Grumman. So just letting you know there are, yeah, I mean, to an extent too, Doctor. Yeah. So again, I'm kind of with y'all with the GDP type logic. And don't, you know, I'm with Dr. Dre here. Don't look at the headline and say, wow, you know, ooh, there's always nuances. There's always little things going on. Again, I think the Russell's a little bit more rangy, but anyway, I'm kind of get out of intraday mode, kind of trying to talk about the big picture here. So there's just a lot of stuff happening. That's really professional, right? A lot of stuff happening, but it's all happening at once, and it's all happening today in the market. With all due respect to the market, can't figure out what to do. Can it go up? Yeah. Can it go down? Or just kind of trapped in a range, or as Don might say, volatility box, range, sideways action. I think it's a little bit more leaning bullishly in terms of the big picture.